How often have we heard that we are witnessing the failures of neoliberal capitalism? Capitalism itself is in its latter stages. For some reason, people seeing a certain amount of visual decay in services in the environment believe that these are signals that we are in the death throes of capitalism. Financialization has gone too far, and the system is in its last days. But is that really the case? From the book, The Fall and Rise of American Finance. By tracing the emergence of financial capital, we show that far from being a feature of a supposedly late stage of capitalism, finance was in fact central to the early development and dynamism of American capitalism. Nor could finance be thought of as parasitic. The amassing of vast pools of money capital in the banks, along with their ability to generate credit, allowed banks to organize accumulation on a massive scale by merging isolated enterprises into giant industrial firms. But these bank-controlled firms were not monopolies. Instead, the emergence of the corporate form and the development of the financial system reduced transaction costs and increased capital mobility, intensifying competitive pressures. The result was the integration of a highly regionalized American economy into a national economy dominated by investment banks and the corporations they owned and controlled. Again, that quote is from the book we'll be discussing tonight, The Fall and Rise of American Finance. Wherever you are watching or listening to the show, there are links in the description to the book so you can read it for yourself. Our guests today, Steve Maher and Scott Aquanno. Steve is the assistant professor of economics at SUNY Cortland and associate editor of the Socialist Register. He is also the author of Corporate Capitalism and the Integral State, General Electric, and A Century of American Power, while Scott Aquanno is assistant professor of political science at Ontario Tech University and a visiting associate at the Global Labor Research Center at York University. He is the author of Crisis of Risk, Subprime Debt, and U.S. Financial Power from 1944 to present. Please welcome our guests, Scott and Steve. Bam, bam.
Thanks, Jason. I appreciate the very real applause. Feels good.
Right? There's nothing worse than when you do something like this and it's just quiet and it's all NPR-ish.
Yeah, exactly.
You know, this is NPR for people that still day drink.
Absolutely.
So one of the didn't know we were going to start off with a zinger. So one of the
we can just go now. That's fine.
Well, this is why I can't get a job on radio. One of the key themes in the book is the concept of financialization and its implications for the economy. Actually, before I even ask the question, I do want to pull back a little bit and say thank you guys for coming on. And also, I'm not done with the book yet. You can yell at me if you want to, Steve, but I've been really busy. And I haven't had a chance to read all 279 pages. But what I'm reading is one of those books that you're learning. For me, you're learning on every page. It is easy to digest. It's not filled with big words and hard terminology. So even if you don't understand finance, these two guys lay it out very, very easy for you. But back to the first talking point. One of the key themes in the book is the concept of financialization and its implications for the economy. Could you explain for everybody what financialization is and how it has led to the prioritization of short-term profit seeking over long-term economic stability and social well-being?
Scott, do you mind if I take
jump in, Steve.
Yeah. So, I think financialization is a very general term, and kind of one of the points we make in the book is that there are different forms of financialization that emerge at different times, and so you can kind of trace the history of capitalist development in the United States by dividing it into different periods in which you have different forms of kind of class hegemony. So we start off with the classical finance capital period, in which investment banks kind of initially played the leading role in organizing the giant multinational, later multinational, but at that time just giant national corporations. Mm-hmm. And that lasted until 1929, clearly a form of financialization in the sense that finance was empowered, right? Relative to industrial capital, finance was the more powerful fraction of the capitalist class. That collapsed in 1929 with the Great Depression, the stock market crash of 29. And through the New Deal, a form of industrial capitalist hegemony emerged, which we call managerialism, in which the industrial corporation was the dominant economic force in society. But within the structure of managerial capitalism dominated by industrial corporations, a new form of financialization kind of emerged within the non-financial corporation, whereby basically the non-financial corporation gradually became a financial institution. And as the managers of those corporations basically became investors, they evolved over the post-war decades into being investors, just allocating money capital, allocating investment across the different kind of competing business divisions that the corporations controlled. So they were diversified firms, and the main decision that these guys were facing were where to send the investment, which part of the corporation. And they were doing that based on competitive criteria. So the corporation kind of became a portfolio of competing financial assets, each vying for investment from the top managers, who basically became money capitalists. So that was, again, financialization in the sense that the logic of finance, what Marx called money capital, that is to say money just becoming more money, was the kind of dominant logic, became the dominant logic within the firm. And then we all know, the neoliberal period of financialization, in which the financial sector became, across the entire economy, the kind of leading force politically and economically. And then we argue after 2008, a new form of financialization emerged that was as the giant asset management companies, BlackRock, State Street, and BlackRock, State Street, and Vanguard, what are often called the big three, replaced the banks as the dominant institutions in the contemporary financial system, and amassed ownership holdings in every major firm, an average of 20% holdings across all the largest firms.
Does it
That's
help?
unprecedented in history of capitalism.
Does it help that after the crash, they're kind of buying up all this debt for pennies on the dollar from the state? Is that part of their growth? Because how big are they before the crash?
Go ahead, Scott. I'll let you.
Wonder Twins.
Yeah.
It is definitely the case that the crisis and the interventions that were made during the crisis, particularly quantitative easing and its various iterations, led to the remarkable expansion of these, passive asset management firms. Passive in the sense that they're not actively managing their portfolio of investments by selecting this stock or selecting that stock, but actually just kind of following an underlying index and buying and selling based on what's happening in that underlying index, right? So the rise of this passive form of asset management was definitely a function of the interventions of the 2008 financial crisis. BlackRock was, of course, a player in the financial system prior to 2008. The book in the final two chapters traces the rise of BlackRock from the 2000s onward. Vanguard has a longer history, and then State Street as well has a pre-2008 history. But these aren't major players in the financial system prior to 2008. And it's really the government's intervention into financial markets and the government's purchase of mortgage-backed securities and treasury bonds through quantitative easing that set off a chain reaction that led to the rise of these asset management firms. So, just very briefly, when the government purchased mortgage-backed securities and, treasury debt to save and to rescue the financial system of, the 2008 financial system, what essentially this did is lead other financial firms to purchase less or more risky forms of debt because they were selling their good treasury bonds and mortgage-backed securities to the state. As they purchased corporate bonds, they pushed other institutions to run into other forms of financial investment. all of these financiers were, of course, searching for capital and searching for return. So the basic effect of quantitative easing was to set off a chain reaction through the financial system that essentially de-risked equity as well as corporate bonds as well. And as equity was de-risked and as equity prices, generally increased across the board, the asset management firms, right, which manage these passive index funds, received an enormous boost because a rising tide lifts all. Their investment strategy in the context of generalized asset inflation, especially equity inflation, became much more profitable, much more desirable, I should say, than the kind of active management strategies that were run by other asset management firms. Just to get back to the point again, it was in fact the interventions of 2008 that stimulated the move into passive management and the massive concentration of equity holdings that BlackRock, Vanguard, and State Street have obtained.